An unexpected surge in job growth last month. The labor market continues to be strong in the face of high rates and the ongoing banking sector issues. Karina Mitchell has more on the big jobs report.
It was a huge beat, 339,000 jobs added in the month of May, blowing past the estimate from Dow Jones of 190,000. This is now the 29th straight month of job gains that we've seen, so not too shabby. Comes on the back of a really strong JOLTS report that we got for April showing 10.1 million openings. That translates to about 1.8 jobs for every person. Layoffs also slowing, so we know that demand for labor remains resilient. But let's delve a little bit more into this report because it wasn't all rosy. Unemployment we saw climbed up to 3.7%, up from 3.4%. That's actually quite a big climb. But when you look at it in context, it's near that record low set in 1969. So it's not actually a bad number when you look at it in context there. And then also wages starting to slow. We saw that go up by just 0.3% this month. Overall, year over year, up 4.3%, so not keeping pace with inflation. If we look at where most of the job gains came, it was in the healthcare sector, 74,000 jobs added there, and then also professional services up by 64,000. We saw hospitality and leisure up by 48,000, also increases in government and construction hiring. So now what's really interesting to me about this report is a juxtaposition between it and some of the other eco data that we've been getting, because we've seen manufacturing is weak, we've seen GDP is anemic. Retailers are really complaining about a consumer that is struggling, that as it shut thousands of stores, big and small names, to try and keep a pace with all of this inflation and changing shopping habits. In fact, Dollar General saying that more of its customers are now turning towards using food banks and tapping their savings and credit cards as well, all highlighting that this is a K-shaped recovery that we're seeing. So now what does the Fed do with all of this information? Well, I asked one economist to see what he had to say. Take a listen.
Right now, if I had to bet my mother-in-law's money, I would bet that the Fed will be standing pat at the June meeting. But that doesn't mean that the Fed is necessarily done raising rates. Listen, we have seen the equivalent of recessions in sectors of the economy, not actual recession, because that is a more demanding definition to be met. But technology has led the way with substantial numbers of job cuts. That is one of the costs of a rising interest rate environment.
So obviously we'll have to wait and see what the result is. The Fed does go quiet now, but it does get one more data point, May CPI, which comes out just a day before it makes its next decision. Karina Mitchell, CGTN, New York.
And all that news made it for a good Friday for the U.S. markets. John Terrett on the last day of trading this week.
What a week on Wall Street, as always. It was a shorter trading week, of course. Monday was the Memorial Day holiday, but the week was dominated by the debt ceiling. First of all, the deal between the leadership. Then it cleared the House. Then it cleared the Senate. And then on Friday, the stellar jobs report for the month of May, with 339,000 new jobs added. Well, that's inflationary, of course, but when you read deeper into the numbers, plenty of signs that the U.S. economy is beginning to slow down. So Wall Street loved all of that, and they had a pretty strong Friday session. Indeed, the Dow had its second best day of the year so far, and it turned positive for the year 2023. So here we go. The Dow ahead by 2.1%, 701 points on the board, and standing at 33,700. NASDAQ up 1%, 139 points, up 2% for the week. S&P 500 ahead by 1.4%, 61 points. 11 out of 11 sectors in the green for the day and the week, and Bitcoin benefited as well to the tune of 1.4%. Now, in the week to come, on Monday, President Biden meets the Denmark Prime Minister at the White House. On Tuesday, earnings from Stitch Fix. It's also the 79th anniversary of the Normandy landings and D-Day in France. On Wednesday, earnings from Campbell's Soup and Vera Bradley. On Thursday, the 75th anniversary of the first road-going Porsche car, the 356. And next Friday is Ascension Day, which is a major religious holiday and a pretty big public holiday in many countries and territories around the world. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more on the U.S. labor market, we bring in Laila Maidan, an investment correspondent with Business Insider. Good to see you again. Look, this is a pretty good time to be an investment correspondent. I've seen records broken into markets, specifically on tech stocks. Things have really bounced back in the face of what a lot of people are shocked by, because we still haven't resolved the rates issue yet. I guess we resolved the debt issue, but somehow these jobs numbers are impressive.
Well, Phillip, you know, at first glance, the reaction is positive, of course, because they're well above expectation. And also the previous jobs report was revised up when we previously were revising them down. So yes, it's positive. But if you look below the headlines, there's also a vastly different story. We heard earlier an economist say that some sectors are taking a really hard hit. So during lockdowns, we saw behaviors of consumers change. Tech-based companies expanded rapidly because anything that you can do at home was gaining attention. And then the service sector was contracting. But what we're seeing now is sort of a reshuffling of that economy. So while tech jobs are being lost, investment banking jobs are also being hurt, we see healthcare and services going up. So that's where a lot of the jobs are being added. But as we saw, also unemployment is coming up. So can I give you a real life example of how some of the headlines can be really different from what reality is? Well, I'll give you an example. So Hamptons this summer, I'm here now. This is the playground of Wall Street. Every year, it's almost impossible to be able to find a place to rent because places are booked far in advance from people, you know, coming from New York City. This year, any landlord you speak to will tell you it is the worst year. They can't even rent their place out for a week. Meta said they're laying off 6,000 jobs last month. Amazon, 27,000 jobs already laid off. Goldman Sachs also almost 4,000 jobs. So it really depends on what sector you're looking at.
Now, okay, out of fairness, Laila, I mean, I know New York very well. I know the Hamptons very well. It is a very unique sort of bubble of very high-income professionals, right? But if you look at the sectors that are benefiting from hospitality and leisure, a lot of these are, I don't want to use the word lower income, but they're more working class. It broadens the economy, if you will. Isn't that healthy for the economy, that it can't just be the rich necessarily getting richer, but sort of everyone sort of participating in the economy? Some might argue that.
Well, what we want to see is an economy expanding everywhere, but you're absolutely right. And this has to do with what happened during the lockdowns when we saw some services expand and companies started hiring more there. Amazon did really well during lockdowns because people were ordering things online. But now the services sector, restaurants, bars, they're all coming back because people are not sitting at home anymore. So while it's not, one is not good and one is not bad, it's just a reshuffling of where jobs are going based on what happened during the lockdowns.
So if we replace Chairman Powell with Laila Maidan, how would you look at these numbers from the lens of whether or not to increase rates, or specifically how to deal with inflation? Because the stuff that I'm reading shows that we still have inflation in the system. Some are arguing that it's slowed down enough, but others are saying that, hey, used car prices are creeping back up, rents aren't coming down enough, and we might see another wave of inflation. I mean, that's a real concern.
Well, Phillip, that's why they say inflation is sticky, right? Because a lot of the talk right now is saying that a lot of inflation has to do with corporate greed, companies just keeping profits up because people are buying the products at that price. However, as rates increase, we saw a rapid increase of rates in a very short period of time. The economy takes 9 to 12 months to catch up. So while we started raising rates a while ago, regional banks sort of saw a crash only recently. So the popular consensus is that the Fed will just pause in June to see what happens. But then again, we do get inflation CPI headlines come out June 13th, really the day before the Fed meets. So depending on how that number comes out, they may or may not change their mind. But right now, we're probably looking at a pause. And I would say that might be a good thing just so that we can see how things are going.
I know you mentioned that tech took a little bit of a hit in terms of jobs, but if you look at the earnings from technology stocks, and even if you strip out sort of NVIDIA and some of the AI stuff that's happening, we're seeing some relatively strong numbers, right, from Microsoft, from Meta, even from Amazon. Maybe they're not perfect, but they're doing awfully well. And Lululemon is not even a tech company, but those items are not for the faint of heart. Somebody is doing a lot of shopping and they're paying for it. So there's sectors of the economy that remain strong. Which ones are they, and which ones perhaps are a little more weaker than we think they are?
Well, the general consensus, what I'm hearing from a lot of fund managers, is that equities are overpriced, and they're not really pricing in a mild recession right now. So there's that risk too, and there could be a correction in equities. But a lot of the S&P's sort of comeback this year, a lot of it had to do with the mega tech giants, and a lot of that had to do with the AI hype. Now, is it a hype, a short-term hype that may sort of correct as we see AI sort of strengthen later down the line? You know, that's highly possible, but equities are considered overpriced right now.
Well, investors are going to, I think, at least take this weekend and celebrate, and we'll come back to this on Monday and have a bigger debate on what the valuations should be. But certainly a very interesting time we live in, especially for investors. Laila, it's good to see you. Thank you.
Good to see you too.